So for here, I would just like to get into basically what I have here is like a trading course, essentially telling you everything that you would need to know about the foreign exchange markets and trading in general. So for starters, the foreign exchange market is the largest market in the world with approximately $5 trillion being traded daily. That's 20 billion dollars being exchanged per hour. This is compared to the stock market, which exchanges $40 billion a year. $40 billion a day, and $40 billion a day compared to $222 billion being exchanged per hour. You could really just do the math on that, and you can tell. Like the more liquid market would be the foreign exchange market. You could trade from anywhere as long as you're connected to Wi-Fi, and you can profit from whether a specific currency is going increasing or decreasing in value, otherwise known as buying or selling. If it's increasing in value, you're buying. If it's decreasing, you're selling. It doesn't require much in terms of like an initial investment, and pretty much the goal of foreign exchange is to buy a currency at an expected rate, um, based on whether or not it's going to gain or decrease in value, and that's basically it's expected to lose value against another currency. Um, so now getting to the main currencies, you have when you're trading, you have the majors. The majors are essentially the U.S. dollar, the euro, Japanese yen, British pound, Australian dollar, and the Swiss franc. When you trade currencies, you never really just trade one because currencies don't fly solo. And now moving into the base, basically like how you would define each currency. When you're looking at each currency, you would have what is called like a base currency, and then also like a gold currency. The base currency in this example would be the red, which is euro, and the pool currency would be the U.S. dollar. So it's basically the euro versus the U.S. dollar. Whether the currency pair moves up or down in value depends on how strong or weak the euro is compared to the U.S. dollar. So in this example, if euro, which is the base currency, is stronger than U.S. dollar, then obviously that means that euro is rising. Um, but if it's weaker than the euro, then that means it's falling, and vice versa. If the U.S. dollar was stronger than the euro, then that means that euro would be falling, and if the U.S. dollar is weaker than the euro, then that means that euro is rising. Um, Getting into how you would define it, um, how you would define looking at the price action of the currency. Um, we'd have to do it in the form of like measurement in the form of a pip. Essentially, the price of euro is quoted in how many U.S. dollars it takes to buy 1 euro. If the price is $1, if you see it says 1.3055, then you just be able to tell that if you were to go to euro, it would take $1.30 U.S. dollars in order to buy 1 euro. And essentially, this is how the way that it's calculated is by price interest points. So with price to interest point, a single pip represents 1/10 of a single unit of currency. So let's say, for example, price action is at 1.18976. If price action goes to 1.18986, then that essentially means that price action has moved 1 pip, and it's the same thing with the Japanese yen. Due to the fact that instead of it being 1/10,000th of a single unit of currency, it's 1/100th of a single unit of currency or of the yen. Next example, and we also have pipettes. Pipettes is essentially a tenth of a pip. So now we're gonna get into the brief history of foreign exchange market, and it all starts with the Bretton Woods agreement, which essentially means that leaders across the globe came together after World War II from July 1st to July 22nd 1944 to determine the fate of the world's monetary system. All participating countries had to peg their currencies to the value of the USD, making it the world's reserve currency, a position that it still holds today. And essentially, the U.S. agreed to peg the value of the U.S. dollar to gold at a rate of $35 per ounce, which is extremely important, and we'll get into that later. Um, President, and this is getting to the beginning of the end of the Bretton Woods Accords. Essentially, President B. Lyndon policy agenda to carry out on war in Vietnam and implement social welfare programs. As the money grew, so did inflation. It went up to 9% in 1968, which is extremely high. I believe inflation right now is at 3.8. And so consumers in the U.S. had more and more U.S. dollars bought and bought cheaper goods and services abroad. But the thing is that increase in imports pushed U.S. trade balance out of whack, which further put downward pressure on the U.S. dollar. To compensate, foreign governments and their banks, which were obliged to keep their currencies pegged to the U.S. dollar, had to start selling their currencies and buying U.S. dollars to lower the value of their trades and raise the value of the U.S. dollar. This this concept is huge. It's essentially called supply and demand, and you'll see it being more implemented as we continue on with the history of the foreign exchange market. So, in August 15, 1971, President Nixon decided to close the gold window or suspend convertibility from US dollars to gold. This gave the United States bargaining power and leverage because, after all, the U.S. wanted everyone to let their currencies appreciate against the U.S. dollar. Essentially, the United States just wanted to have control, being that they are the world's reserve currency. So they decided to negotiate things in their own terms, if that makes sense. The Smithsonian Agreement essentially was a hard reset for currency values. It did nothing to address the problems that led to the end of the Bretton Woods Accord. And with the European joint float concern of exposure to the US dollar, the European community established this joint float system within these rules. Essentially, each country had to stay within the snake, which is like it's basically like supply and demand, if I was to describe it. And with the end of the Smithsonian Agreement and joint float and expansion in U.S. money supply, a jump in the value of gold to more than $100 per ounce, and a lack of ability from foreign countries to continue buying the U.S. dollar, faced markets to devalue the dollar. And now, with the Jamaica Agreement, in January 7th and 8th of 1976, the International Monetary Fund finally formed a free-floating currency system. Basically, with the IMF, floating currency rates were now acceptable. IMF members could enter the forex market as they saw fit to temper unwanted price fluctuations. Gold would no longer be used as a reserve asset, and the IMF would return all of its gold to its members nations. With this, world leaders finally acknowledged they possessed neither the tools or the will to control currency rates. Basically, world leaders try to like manipulate the currency markets, but you'll often find that it's not often that you'll be able to do so. So basically, what do we learn? Going through this brief summary, we learned that the basic forces of supply and demand drive the forex markets. Trade values, investment flows, and money supply all play key roles in driving supply and demand. Government interventions and currency manipulation can last only so long. So, moving forward, just getting into the key concept of supply and demand. Basically, when supply and demand increase, the lines on this chart here you see here will move horizontally from left to right on the axis, versus when they decrease, um, instead of going left to right, it goes right to left. Um, so going into what it would look like, being that if the price rises, as the demand, so will demand. Well, actually, if demand increases, then so will the prices. Um, and it's the opposite will happen if supply increases, then the price falls. Um, so this essentially means, if you, let's say for example, you to have like your favorite pair of shoes, right? Favorite pair of basketball shoes. Um, the more coveted it is, the shoe, like the more coveted the shoe is, the more like people want to see the shoe, the more people want to buy the shoe. Then of course the more expensive the shoe would be, and it's more likely that the supply of that shoe would be like a limited release, versus if you were to get like a pair of Shacks from Walmart, right? The price would fall. It'd be a cheap shoe, but then at the same time there would be more supply of that shoe, right? Um, going in versus going into, let's say for example, uh, if demand decreases, then that means that the price will fall, right? But if supply decreases, then that means that the price would rise. So essentially, the more price like the more like people don't want to buy the shoe. Let's say for example, right? The more demand decreases for the shoe, the more the shoe's not popular, then more people are gonna put the shoe on sale, for example. Versus if let's say supply decreases, then that of course means that the shoe is selling out. Like concert tickets, for example. If the concert tickets are selling out, then the price would rise. Um, they'd be more expensive. People don't want to, they'd have to pay more. So, supply and demand are driven by five factors. These five factors are trade flows, investment flows, money supply, government intervention and currency manipulation, and investor fear. So, let's get into more of what that would look like, right? For example, trade flows are essentially it represents the money that flows from one country to another as a result of the trade of goods or services between two countries. It can be affected by these two things: foreign demand for domestic goods or domestic demand for foreign goods. That essentially means if I'm selling something out of my backyard and somebody from Japan wants to buy my stuff, that's foreign demand. They're from a foreign country and they want to buy my domestic goods. You know what I'm saying? It's just the way it goes. Now, if I were to buy something from Japan, for example, that'd be my domestic demand, and it's going, I'd be buying foreign goods from Japan. It also happens when buyers and sellers engage in international trade. The flow of money from the buyers to the sellers increases the value of the seller's currency and decreases the value of the buyer's currency, right? Now this varies from government agencies around the world that report monthly trade balance numbers. So it's basically like every country has to, basically, tell each other how they're doing. Every month, the Census Bureau essentially has to do these calculations and whatever the case may be, and release international trade and government services and goods, and you gotta release the numbers. So if a country has a trade surplus with another country, it means that it has a greater foreign demand for domestic goods, and that there was domestic demand for foreign goods. Then this essentially leads to a strengthening in the domestic currency compared to the foreign currency. All other things being equal. So if one country is essentially like buying more things from another country, like for example, if we're buying a lot of bananas and stuff like that from DR, Dominican Republic, right? That's essentially going to strengthen the currency of DR because we're investing into that country essentially. But if a country was to have a trade deficit with another country, it means that there's a greater domestic demand for foreign goods, and that there was a domestic demand for foreign goods. And this essentially leads to a strengthening of foreign currencies compared to the domestic currency, and all other things being equal, this basic premises of a currency pricing model is basically called the balance of payment theory. Right? So that's trade flows. Now investment flows. This is where we get into the appreciation of assets, right? Where it's like, for example, like investment flows, they represent the money that flow from one country to another as a result of a purchase or a sale of assets in a country by an investor from another country, right? So let's say, for example, if in the investment flows, foreign demand for domestic goods, um, and like it's affected by these three things. Like investment flows is affected by these three things: foreign demand for domestic goods, domestic demand for foreign goods, and reappreciation of assets. Now, the reappreciation of assets is my favorite. Personally, I feel like there's money to be made there. Repatriation of assets essentially means when a company makes money overseas, they can either keep the foreign currency or they can bring their profits back home to the United States. Now, you can watch these earnings and announcements of large multinational corporations. If they make good money overseas, it's likely they'll take those profits home. The U.S. can also lower tax rates for corporations, and this is called the Homeland Investment Act, right? From as high as 35% to 5.25% to entice companies to repatriate funds, meaning bullish effect of the value of the U.S. dollar, increasing its demand. So, for whatever reason, if the United States feels like they need to increase the value of their currency, what they'll do is they'll lower the tax rates for countries. Like for, I know Elon Musk, he has with Tesla, he has let's say, for example, he has Tesla factories in China. One thing that he would do is that he'd be making his money essentially from China, right? And he can either keep, the Chinese money, like money that he's making there, or he could bring his profits back home to the United States. And essentially, by him doing that, him bringing business back home to the United States, they make money. So a little sidebar is that, like, it's like, why, a question to ask is like, why not speak to Congress about receiving funds as well as property from Africa that they own, and will in turn reappreciate the assets. That's just something I like something to think about, honestly. But the U.S. Department of Treasury does a pretty good job of summarizing the investment flow data in their monthly Treasury International Capital data report. Sorry, as well as another thing that's really important is the interest rate parity theory. It's essentially a concept of a currency getting stronger when the country offers higher interest rates than other countries as a basic premise of another currency pricing model. So essentially, higher interest rates, stronger currency. And this theory suggests that investors are also looking for the highest return on their money for the least amount of risk. Give me 1 second. So now, I'm not editing that out. I'm not gonna lie to you. Money supply, right? Money supply represents the total amount of currency that is circulating through the economy. It is important to traders because it has a direct impact on the value of a currency. More money in circulation means more lower currency values, while less money in circulation means higher currency values. That's supply and demand for you, right? The more there is a supply of a currency, the more there's a supply of a currency. That essentially means that prices will be lower versus the less supply there is of that currency. That means that it's higher currency values, right? The money supply in the country is dictated by the government's treasury. So for us, it would be the Feds and the country's central bank, right? So purchasing popular parity theory, a concept of a currency getting weaker when a country that it issues it starts experiencing a rise of inflation, right? This theory suggests that you're able to buy the same basket of goods for the same amount of money, regardless of which country you're in. Right? Now, moving forward, government interventions and currency manipulation. Right? Outright intervention. When a government actually goes out and manipulates the value of its currency by either buying or selling that currency on the open market. So basically, a country can buy its own currency in order to make its own value go up, just outright, just like intervening if need be. Verbal intervention is just something where a government threatens to manipulate the value of a currency via open market transactions, but doesn't actually pull the trigger. Another way is that, and this could be in two forms, right? It's like coordinated intervention, where it occurs when more than one government body gets together and decides to intervene in the market. That could be like um, the European government when they created the euro. That's kind of something that they did. The EU. Or they can do unilateral intervention, which is when a government decides to act on its own and take matters into its own hands when trying to manipulate the value of a currency. So why would a country intervene? It's most likely due to the fact that it's worried that their currency is too strong, or worried that the currency is too weak. And this is like essentially what they want to do is they want to make sure like that supply and demand area is always in that sweet spot, right? And it's always because it's pegging the currency to another currency. So lastly, for reasons, lastly for supply and demand driven factors is the investor fear. Sometimes investors can send currency prices soaring or crashing when times are rough. Safe haven currencies thrive when investment fear is of running amok. This is because of the perceived protection that they offer during times of financial turmoil. So, something that countries would do is like they'll run to the U.S. dollar, and whenever there's like a war or anything going on like that, the most popular safe haven currencies are the U.S. dollar, the Swiss franc, and the Japanese yen because they happen to be the most stable of currencies. The U.S. Because of crisis, the U.S. because crisis investors flock to safety of the U.S. Treasuries. The franc because its majority of it is backed by gold, and the yen because unlike U.S. Public debt, which uh, which is held largely by foreign goods and investors, Japanese public debt is held exclusively by individual Japanese investors. So that's why it's so important. This is very important. And there you go.